So, scenario 2. Let's say that Apple is going up, but not all the way to 290. Let's say Apple is only going up to 270. So it is staying below the strike price that we have up here, the strike price of 280. So what does this mean? The buyer right now, how much is the option worth? If you have the right to buy the stock at 280, but it's only trading at 270. How much is this option worth? Nothing. So as a buyer, you're out $1.20. You lost $1.20. As a seller, you're happy right now because the stock stayed below the strike price. So this means that nobody is going to exercise this option. You keep the $1.20 and you don't have to give anything back. Therefore, you're making $1.20. Let's go back to scenario 1. If Apple moves above the strike price, the buyer is happy and the seller is unhappy. In scenario 2, if the stock price stays below the strike price, the buyer is unhappy and the seller is happy. Okay? Is this making sense? Okay, good. Again, we talk about these option strategies. This is why I said, okay, a call buyer is happy when the price goes up, and a call seller is unhappy when the price goes down. But we also talked about it that we can switch it around a little bit. And that's what I'm going to do right now before we move on here. Is this making sense thus far? Because if it does, click on like. This way I know that we are going at the right pace. Again, if not, watch it again. Don't worry, you will get it. Again, we're going here at a super high speed. And if right now you're already getting it, good for you. I mean, congratulations. Honestly, when I first learned about options, I would have to watch this probably 3 or 4 times before I'm getting it. But trust me, it is time worth investing.